Hi, good evening. Today we have got Manpreet Gill, our head of fixed income, currency and commodities, to give a short brief snippet about her global views. Hi Manpreet.
Thanks, Vinay.
Higher crude oil is also a big worry for India, and we have seen a sharp rally since late 2017 in crude oil prices. Where do you think crude oil prices is heading going forward?
Well, not too far away from where we are today because, oil prices, look, short-lived excursions to $80 are absolutely possible based on one-off events. But for oil, when we look at the oil market, we come back to the basics of demand and supply. And what's changed recently is that there has been a much greater willingness on the part of the key suppliers to meet sort of the growing sources of demand, and second, to compensate for some of the one-off outages we've seen in limited markets. We know that risk events like sanctions on select markets are coming through, but those are well known now, so likely priced in by the market. So we just think when you take a longer-term perspective, we think staying below $75 per barrel, most probably in the range of about 65 to 75, makes a lot of sense to us.
We have seen a sharp rise in US rates. We have seen a rise, a tightening of global liquidity, and we have seen a rise in volatility. Emerging markets assets as well as currency have corrected YTD. So what is our preferred call now in assets as well as in country-wise, and where does India stand in the pecking order?
Sure. I think that actually comes back to a core theme, which is one, to be bullish, but also to keep diversification in place. I think from an allocation and a preference perspective, look, we still like equity markets, and we like the US more than others, but actually most Asian emerging equity markets should do well in a late cycle environment. I suppose the fall in global liquidity ultimately brings us back to a conversation about the US dollar, because I suppose that represents the single biggest risk to continued flows into emerging markets. We expect the dollar to weaken because we just think interest rate expectations in the US have already gone quite far. And if that pans out, and then flows to emerging markets like India should resume, and that's actually a good outcome for emerging market equities and for emerging market bonds. However, even if we do see the dollar sort of hold up against our expectations, equity should still do well in late cycle, and particularly the US, which usually tends to outperform towards the very end of a business cycle.